Management, Kulin Lalbhai is the ED of Arvind Limited, who now joins in on the show. Great to have you on board. Many thanks for joining in. To begin with, you've announced very ambitious targets for the company. This is over the next 3 to 5 years. So give us a sense as to which are the pockets where you're seeing creating a value opportunity.
If you look at our company, one of the things very unique about us is how we dominate the casual and youth space in menswear. We have by far the largest market share. And what's happening in a country like India, because we are so young, the market is completely pivoting towards casuals and youth. So we have seen this kind of structural, very interesting growth opportunity. And if we look at India, we are just about at 2,000 per capita GDP. Usually when other economies of the world have reached this mark, there is a huge increase happening in disposable income towards apparel. So in a sense, we are at the beginning of the S-curve. If you look at the last 4 to 5 years, we've been consistently growing at more than 20%. And I think it's this structural market opportunity which allows us to really continue that sort of traction and growth. And because casual and youth is where structurally the market is pivoting to, we have a huge opportunity for growth across channels, be it stores, key accounts, even online, which is growing exponentially.
Global stories like Abercrombie Fridge going bankrupt, I read in the morning Diesel has gone bankrupt. It just makes you wonder that what's happened in America to branded retailers, brick and mortar stores. What is the future here? I'm trying to compare apple and oranges, I agree, but just as a trend, it's a puzzling trend, isn't it?
Yes, I think you have to understand where economies are in their stage of evolution. In a country or an economy like India, apparel is much more than something which is about self-expression. Apparel is about signaling to society that you have arrived, which is why, contrary to developed markets in India, if the logo is not strong, if the brand aspiration is not strong, a product will not sell. If you look at all the data, branded apparel, which is the logo-driven apparel, is growing at 2 times the rate of the normal market, which means there's a huge shift happening from the unorganized to the organized and from the unbranded to the branded. And looking at the fact that India is still a low-income country, I don't see, the market moving from, projecting brands to self-expression anytime soon. There is no trend line at all which suggests that happening in the future. Secondly, Arvind should not be thought of as a brick and mortar retailer. We are a multi-channel brand company. So wherever our brands sell, it's great for the company. And so for us, as the market is rapidly growing in online, it's a phenomenal opportunity. 2-3 years back, online did not exist. Today, it's 15% of our business. I could see a future 5 years out where it could be 30% of our business, because what's also happening in online is our products are reaching places they never did before. We are only in 200 cities with physical retail, but now we are in every pin code with online. So online is a disruptive opportunity for a company like us. And for us, as long as our brands can reach the right customers, we are very happy, whether it is through a retail store or whether it is through online.
Sure. But Kulin, by when can we see operating leverage kick in to fuel further margin expansion and cash flows for you? And by when can we see all your brands actually turn positive?
Yeah, so if you look at the operating leverage story, even over the last 2 years, there's been strong operating leverage coming in. And what's behind that is each independent brand is scaling up. So if we look at next year, we're going to have a US Polo, which will be more than 1,000 crore net sales, and that's almost 2,000 crores at an MRP level sale. We'll have 4 brands between 500 to 1,000 crores, and we'll have 3 brands between 200 to 250 crores. So what that means is that our portfolio is really coming of age, where each brand is scaling up. And that's what's behind the operating leverage. So if you look at the last 2 years, you have seen it happen between 100 and 150 basis points. And as the portfolio continues to mature, we believe that that's a natural rate which we can achieve, which would lead to not only enhancement in our operating margin, but also very importantly a significant bump up in our return on capital employed.
Right, now I understand that you're going to focus as well on boosting your online sales. So what are the businesses that you're looking at for going ahead and doing that? And also, are you creating exclusive product categories for going online? And how much of this will be a contribution to your total sales?
Yeah, so historically, we have been scaling up very well with the third-party marketplaces. Again, online is where the casual and youth really are. Those are the segments which scale up, and because the portfolio is so strong there, we have been kind of a leading market share when it comes to third-party marketplaces. And what began with offline product being sold online is quickly evolving into a business model where you quickly realize what is selling online, and you create specific products across all our brands for the online market, and that's what has led to a lot of exponential growth happening. The other major thing the company has got into is investing in its own omni-channel efforts, which means we have launched our own .com a couple of years ago. And what's unique about our strategy is we have connected the online with offline, which means all the stores, inventory is connected with online, which means a huge amount of new inventory and product becomes available to the customer. And the store retail sales actually are piggybacking online growth. And whilst we've been growing rapidly, that part of the business is hitting a lot of traction. In fact, the last quarter we saw 600% growth year on year in our omni-channel business. So that is dramatically scaling up, and that's a very healthy business model, because it is linking online and offline and giving the customer the benefit of both worlds. So between third party and online, it's around 15% of our business as of this year, and possibly it could be closer to 18-19% of the business next year, wherein good 20% could be our own .com and 80% will continue to be the very large scale third party marketplaces.
Fair point. Kulin, as I understand, you're also targeting 20% of your revenue to come in from franchisee stores. Have you set any timeline to actually achieve this target, and what really is the rationale behind this?
No, actually, in the branded part of our business, which is 60-70% of the business, we actually are dominated by the franchisee model, because in retail, brands rarely invest in the fixtures and furnitures themselves. We have great partners who come in, put in capital. So 80-90% of our retail network on the brand side of the business is franchisee-led. It's always been that way. That doesn't mean the company does not control operations and inventory. That's where we have full control. But capital comes in from partners. It makes the whole business model much more capital efficient and allows us to rapidly scale up. We open close to 150 to 200 stores every year, and a large chunk of those are through our franchisee partners.
And the Indian apparel market, that stands at about $56 billion. It's the second largest retail market behind the food and grocery space. What is your growth projection? Because, the market as well is expected to grow quite smartly. How are you going to ride on this huge opportunity? What are the long-term targets that you set for the company?
Yeah, so if you look at this market, because there's this huge demographic dividend kicking in, the structural market itself tends to grow at high single digits, 8 to 10%. Within that, as I mentioned, the branded part is growing rapidly. There's a huge shift happening from unorganized to organized. So the branded market would, say, be growing at around 14%, 15%. And because we believe we have brands with the highest level of aspiration and a very strong product market fit because of the strength of casuals, we as a portfolio tend to grow at 18-20%. So I think there is the structural opportunity, and then the focus on making the brands the most aspirational, so that one grows faster than not only the market but even the branded market. So that's been what the company has been focused on. And as I mentioned, there will be 8 to 9 very large brands dramatically scaling up, and some of them are very early in their scale-up journeys. So there's a lot of opportunity for us to grow, whether it is through an expansion of channel, which is distribution, the stores and online, or also the number of categories that we have in each one of our brands.
We wish you all the very best on your new journey. Thanks so much for joining in and giving us a heads up as to how business is shaping up, your targets, projections, and growth opportunity.
Thank you so much.